Thanks for tuning into the KEES Lending Podcast. There's a million bajillion podcasts out there. Everyone and their mom's got a podcast, right, Matt?
Yep.
So we really appreciate you for tuning in. On today's episode, I got to share with you a success story. I mean, this is really a mind-blowing success story, and I just think it's awesome. And I think this story might be able to help a lot of those individuals that are interested in, purchasing out-of-state rental property, especially if you're in California, or buying rental property to add to their real estate portfolio with the goal of having enough cash flow to offset your current expenses. Let me say that in layman's terms. At the Singh household, we have close to, $6,000 a month in our survival number. How we came up with this is my wife and I devised a Excel spreadsheet. I would love to say that she participates monthly with me in the budgeting. She doesn't. She actually, as much as I beg her and ask her to get on the same page with me, we're just not there. It's actually one of our biggest fights. Talking about money is one of our biggest, fights. And I'm sure there's a lot of people that are watching or listening to this that can relate to that. So I have decided to take charge and, we do a monthly budget. And, in today's banking era, your banks actually really do a great job of helping you with it. Instead of using great softwares out there like Mint or Personal Capital or things like that, or even Intuit, QuickBooks, where it, can download your history from your bank account and kind of do a quick audit of it, and break it down to you in like a pie graph. You can actually, if you bank with Chase or US Bank or B of A, many of the big 5 banks actually offer this technology to you for free. On the first of the month, I look at last month's history. I look at the pie graph to see what got spent where, what went to bills and utilities, what went to, eating out and meals and entertainment, what went to groceries, what went to, fund money, what went to savings, what deposits came in. And this helps me create a personal profit and loss statement, if you will. But it goes a little deeper than that. And the Excel spreadsheet shows, what areas we actually spent money in. After reviewing it, I looked to see where we could improve upon. So one thing that we really are trying this year to get better at is eating out. Because I come from a workaholic background, it's almost like a way for us to connect. So that Friday, Saturday, or Thursday, Friday, Saturday comes around and we'll go to a nice restaurant for lunch. We'll go to a nice restaurant for dinner. Dad and mom don't have to cook. It gets us around the dinner table at the restaurant. We get to have a boisterous, nice ambiance, some chips and salsa, or whatever it might be, and a drink. And now we're just hanging out, and it becomes an outing, if you will. But that adds up, especially if you do it every Thursday, Friday, Saturday, Sunday, and you end up scratching your head and going, dang, I spent $2,000 eating out this month. What? So these are the areas that stand out more when I'm doing this personal budget. If you want a copy of my personal budget, the Singh household budget that I use, just message me and I'll make sure to send it out to you. And if you have trouble utilizing it, you can book a Zoom call with one of my staff or even me, and I'll review it with you very quickly. Maybe we'll do like a live Zoom training if there's enough people that are actually interested. So first of the month, I look back at the historical of what we spent that month. I do this every first of the month, and I see where we are improving upon what areas need to improve. At the bottom of my Excel spreadsheet, it tells me my survival number. My survival number is going to be any expenses that I spend money on that I need to spend money on. Okay. On the right-hand side, I have my wants. So anything that I'm spending money on that is a want, not a need. So let me give you an example. On the left-hand side, I have my life insurance. I have my mortgage payment. I got my insurance payments for health insurance, car insurance, home insurance. I have my, PG&E bill. I have my internet phone bill. I have my grocery. I have my anticipated gas, for vehicles. On my right-hand side, I have like gardener, landscaper, pool guy. I have all that stuff that I don't really need. They're luxury items. I can totally say, hey, you know what? Bye-bye. I don't need a gardener anymore and pull weeds and mow my own lawn, but it's nice to have. My survival number at the end of the month boils out to $5,714. That's what it really is. Okay. So a little under $6,000. So a lot of the people that I'm dealing with right now, especially the client that I'm going to tell you about, when he did his survival number, it came out to the same amount, or like close to the same amount. He's, my age as well. He's in his 40s. And he said, Sunny, I have a goal of trying to figure out how I can buy rental property that can cash flow enough to cover the cost of my living expenses. Now, he didn't go so deep. He didn't say, hey, you know what? I need to make $5,700 or $6,000 times 12. I need to make that per month. And then it also needs to be after taxes. Now, he didn't do all that. Okay. What he did was he said, hey, if my mortgage on this house is going to be $1,200 and I rent it out for $2,000, that's $800. He didn't do any type of vacancy. He didn't do anything like that. He just kept it simple. He said, if I can cash flow $1,000 to, $800 a month or whatever my number is, well, then I would need to buy 5 to 6 homes and I would be able to get my goal of being able to have enough cash flow coming from other people who are renting my property. Think about it. They're paying his mortgage. They're paying the difference. The difference between the spread of the rent and his mortgage is the cash flow. And he's taken that and he's using it to pay for his cars, his house, his PG&E, his energy, his groceries, to where now his income and his wife's income that comes in after tax is extra gravy that they can use to sock away in savings or further invest into the stock market or whatever they want to invest in, their 401ks, whatever. He was able to hit this goal, but he had some challenges in front of him. He had 3 challenges in front of him. The first challenge that he had was, well, he's a correctional officer, so he makes about close to $100K a year. And he already owned a mortgage. And the mortgage we designed for him was during COVID. We got him a 15-year loan. A lot of my clients, mimic me. They mirror me, and they're conservative. I'm here in Placer County. So it's pretty conservative here as well. I think that's why my family and I chose this area. It's a great place to raise kids. Topic for another day, but he's conservative. He has a 15-year loan on that. And during the time that we did his mortgage, his debt to income ratio was already at 43%. So his debt to income ratio is already kind of maxed out. Okay. I'm not using his wife. I don't want to overcomplicate this. So he goes, Sunny, how do I achieve this? How do I buy these rental properties? He didn't even ask me, the tougher questions. He said, how do I buy them? I can access my 401k and I can access my checking savings account money. Not to mention I have a ton of equity in my home. I could slap a home equity line of credit on, but how do I qualify since my debt to income ratio is already kind of at the max point? I said, well, we have a program called a DSCR. And in a nutshell, how it works is if the mortgage is $1,200, the property needs to rent for $1,200 or higher. And if it does, they neutralize and you can qualify to purchase a home. The rate is a little bit higher than a traditional conventional loan, but essentially they're not going to ask you for your W-2s, your pay stubs, your anything. They're just going to ask you for your bank statements to show that you have funds for the down payment. And you could buy this with, 20% down. He said, great, I'm in. There's no PMI because there's 20% down. We're using non-invasive paperwork to get qualified. And all we're using is a forward rental agreement as well as the appraiser to notify that, yes, the rents are, verifiable, that this is what the rents are for that area. And so that's what we did. The second hurdle that he had was, where am I going to find these properties? Where am I going to invest? So he literally went on Zillow and he went to every state. He came up with the filter criteria of his homes. So his filter was anything that was 1970 built or newer. He wanted at least a 3-bedroom, at least a 2-bathroom. He wanted them to be turnkey, not need a lot of work to them. And he spent quite a bit of money on inspections on homes that he backed out of. He wanted to make sure the HVAC was working. He wanted to make sure the foundation was good. He wanted to make sure the roof had life on it. So these reports cost money. So he went to every state. He went to every state that was landlord friendly. And he identified 2 states that he could go to, that he felt comfortable in. Him and I then started formatting a list of questions to ask. Like contacts that we needed that were boots on the ground, property managers, contractors, things of that nature. And we did it together. It was eye-opening for me. He flew to those 2 states. He went to the cities that he was most intrigued by. asked all the questions he needed to ask, and he started buying property. He found a couple realtors, he narrowed it down to one, and he started buying property. Fast forward to less than 100 days later, he ended up buying a total of 6 properties. And those properties ended up cash flowing what he needed to cash flow. He asked me if, the third question was, where do we come up with the down payment? Again, his checking and savings would have been hard-earned after-taxed money. We looked at the home equity line, but the rates were between 10 and 12%. We decided that wasn't for him, especially because we constructed a 15-year loan. Okay. So we looked at his 401k and he borrowed from there. So he borrowed $50K from his 401k and he used another $100K from his checking and savings account. You're probably wondering, like, how does that make sense? Like, he has $150K to work with. How does that make sense? Well, he bought $100,000 properties. Kind of crazy, right? He bought $100,000 to $120,000 properties. His total loan balance for these total homes became somewhere in the mid 600s. 20% of 600 is $120K. He was able to make this work. He doesn't have plans to purchase another set of 5 or 6 properties until next year. But this is somebody who's never invested in real estate before other than his primary residence. This is somebody who was able to solve 3 pretty tough problems that would have stopped a lot of people dead in their tracks. And this is somebody now who has 6 properties, remote owned, property managed by a hell of a property management company, tenant placed. They have growth and appreciation, and he's cash flowing on them. And it's helping offset his total expenses. He may not all the way be there, but he is tackling, by way of his cash flow, covering his overhead, sizable amount. This is a great story, and this story could be you. If you have any interest in learning about the questions that we asked, or learning about how we came up with the budget of our survival number, or how we identified those properties and how we came up with boots on the ground contacts, please reach out, because we went to this process. We made it thorough. We did after action after after action to dial it in even further. And I'd love to help you achieve that financial freedom. Let's not make it sound like a cliche. Let's actually make this come true. So before you go out and buy a business and buy yourself a job, you may want to think about, increasing your portfolio, your rental portfolio, investing in real estate. Thanks for listening. Thanks for watching. If you have any questions, please don't hesitate to reach out. If you liked what you saw here, you liked this story, make sure to hit that subscribe and follow button.